What's up everybody, this is Leaf with Adaptable Wealth, and in this video we're going to investigate the effectiveness of residential real estate as an inflation hedge. As I dug into the data, I realized I had to answer this question from two different angles. First, does it generate a positive real return over the long run? Second, how does it do during short-term spikes in inflation? Over long periods of time, I'm talking 50, 75, 100 plus years, it beats inflation, but not as much as you'd think, and way less than stocks, and it even trailed bonds. It beats inflation by approximately 0.4% per year compounded annually. That's that gray linear regression-based trend line through the middle of the graph. If you consider the real trend line to be at the lows of each cycle once all the malinvestment gets washed out, which is the green line, then it beats inflation by 0.2% per year compounded annually. I don't think a strong case can be made that the orange line is the right long-run trend line, and that beats inflation by only 0.6% per year compounded annually. During shorter periods of inflation spikes, the results are more mixed, with national housing prices tending to rise less than inflation. Since 1890, we've had 7 periods of high inflation, which I define as 5% or more annual increase in the CPI. To summarize, of the 7 periods where the CPI increased by 5% per year or more, national house prices, as measured by the Case-Shiller Home Price Index, trailed the CPI 71% of the time and returned, on average, 3% less than the CPI over those periods. However, it's important to note that even though house prices underperformed relative to the CPI, they still increased in all periods. They just didn't increase enough to offset inflation, which means you lost purchasing power. You didn't actually lose money, just purchasing power. I also looked at the 10-year compounded annual growth rates of the Case-Shiller Home Price Index versus the CPI. Of the 30 rolling 10-year periods with an average annual CPI of 5% or higher, national house prices trailed the CPI 13 times, or 43% of the time, and they trailed the CPI on average by 2%. National house prices beat the CPI 17 times, or 57% of the time, and they beat the CPI on average by 2%. To sum all this up, real estate prices tend to underperform inflation during short spikes in the CPI, but over periods of 10 years or more where the CPI runs at 5% or more annual rate, real estate prices keep up with inflation, and over super long periods of time, they will slightly outperform inflation. Of course, this analysis only focuses on real estate price movements. If you factor in other sources of returns covered earlier in the video, real estate handily beats inflation over 10-year periods or longer, especially if you rent it out. Well, that wraps up this video, folks, but I have many more videos on real estate. If you ever wondered whether or not residential real estate is a good portfolio diversifier, take a look at my video up here. Or perhaps you're new to real estate and would like to learn about the 5 ways you make money investing in properties. If that's the case, take a look at my video down here.